Welcome back to Managing Your Business by the Numbers, where we break down essentials of business management so you can make informed decisions that drive your success. Today, we're focusing on a topic that's absolutely critical for financial health of your business: working capital management. If you've ever wondered how to ensure your business has enough cash to operate smoothly, or how to use your resources more efficiently, this video is for you. We'll build on what we've discussed in previous videos about liquidity and cash flow. So if you're ready, let's begin. What is working capital? At its core, working capital is the lifeblood of your business. It's the difference between your current assets, things like cash, accounts receivable, and inventory, and your current liabilities, such as accounts payable and short-term loans. To put simply, working capital is what you have left over after covering your short-term obligations. The formula is straightforward. Working capital equals current assets minus current liabilities. Let's break that down with an example. Suppose your business has $100,000 of current assets and $70,000 in current liabilities. Your working capital would be $30,000. This 30 grand represents the cushion you have to cover unforeseen expenses, invest in growth opportunities, or simply keep your operations running smoothly. But it's not just about having a positive working capital. You need to manage it effectively to ensure your business remains financially healthy and poised for growth. And that's what we're going to dive into next. Why working capital needs management? Now you might be thinking, if working capital is just cushion, why does it need management? The answer lies in its critical role ensuring liquidity and operational efficiency. Let's start with liquidity. Proper working capital management ensures that your business can meet its short-term obligations without relying on costly short-term financing. This is particularly important during periods of economic uncertainty when cash flow is tight. Next, managing working capital can optimize your operational efficiency. For instance, by managing your inventory, your receivables, and payables strategically, you can streamline your operations and reduce waste. This can shorten your cash conversion cycle, the time it takes to convert your investments in inventory and other resources into cash flows from sales. But it doesn't stop there. Proper working capital management can also support business growth. By freeing up funds that would otherwise be tied up in inventory or receivables, you can invest in new products, expand it into new markets, or improve your existing operations. Let's not forget about risk mitigation. Poor working capital management can lead to cash flow crises, forcing you to rely on expensive short-term loans or even leading to insolvency. By maintaining a healthy buffer in your working capital, you can better handle unexpected expenses or economic downturns. Let's talk about some key strategies for managing your working capital effectively. First up is cash management. One of the most important aspects of cash management is forecasting. By regularly reviewing your cash flow statements and projections, you can anticipate any cash shortages and take corrective action before they become a problem. But it's not just about having enough cash on hand. You also need to avoid holding too much idle cash that could be better invested elsewhere. Techniques like cash pooling, cash sweeps, and treasury management software can help you optimize your cash balances. Now, when I say maintain an optimal cash reserve, I don't mean stashing cash in your office drawer like a pirate hoarding treasure. Although, if you do have a treasure chest lying around, I'd love to hear that story in the comments. Next, let's look at inventory management. Inventory turnover is a critical factor in working capital management. The faster your inventory turns over, the less cash you have tied up in stock. But it's a delicate balance. Too much inventory can lead to high holding costs and obsolescence, while too little can result in stockouts and lost sales. Methods like just-in-time inventory management, economic order quantity, and ABC analysis can help you optimize your inventory levels. Managing inventory is like cleaning out your fridge. You don't want too much stuff in there because, let's face it, no one needs a year's supply of expired mustard. And just like you wouldn't want your lunch guests to discover a science experiment in your fridge, you don't want your customers to find out you're out of stock when they need you the most. Moving on to receivables management. Optimizing accounts receivable is all about getting paid faster. Strategies like offering early payment discounts, conducting credit checks on new customers, and tightening payment terms can help you improve your cash flow. But it's also important to keep an eye on aging receivables, accounts that are overdue. Regular follow-ups and collections are essential to ensure that you're not left with bad debts. If necessary, you can also consider options like factoring or invoice discounting to improve your cash flow. Chasing overdue invoices can feel like herding cats, especially if those cats are particularly good at dodging your emails and calls. But remember, persistence is key. Or you could try the unexpected visit approach. Nothing says pay up like showing up at their office with a smile and a box of donuts. Just kidding. Maybe save the donuts for when they actually pay. Finally, let's talk about payables management. Managing accounts payable effectively means striking a balance between maintaining good supplier relationships and optimizing your cash flow. This might involve negotiating longer payment terms or taking advantage of early payment discounts. But be careful not to delay payments to the point where it damages your supplier relationships. Balancing your payables is a bit like balancing plates at an all-you-can-eat buffet. You want to load up on the good stuff, like negotiating better payment terms. But don't pile your plate so high that you can't make it back to your table, or in this case, pay your suppliers on time. And remember, nobody likes the guy who takes all the crab legs and leaves nothing for the rest of us. So play fair with your suppliers. While managing working capital might seem straightforward, there are common pitfalls to watch out for. One major mistake is over-reliance on short-term debt to finance long-term investments. This creates a mismatch that could lead to liquidity issues and even bankruptcy. It's crucial to align your debt terms with the life cycles of the assets they're financing. Another common mistake is ignoring the timing of cash flows. Even if your business is profitable on paper, mismatches between the cash inflow and outflows can lead to cash crunches. That's why it's so important to understand the timing of your cash flows and use tools like cash flow forecasts to manage this effectively. Neglecting inventory turnover is another mistake that can hurt your working capital. Slow-moving inventory ties up cash and increases the risk of obsolescence. Regular inventory reviews and adjustments are essential to ensure your inventory is turning over at an optimal rate. Finally, failing to manage receivables effectively can have a significant impact on your working capital. High accounts receivable means that cash is tied up in unpaid invoices, which can lead to liquidity issues. That's why it's so important to manage your credit terms carefully and follow up regularly on overdue accounts. Effective working capital management doesn't just improve your liquidity, it can also enhance your overall business performance. For example, by optimizing your working capital, you can improve key financial metrics like the current ratio, quick ratio, return on assets, and return on equity. These improvements can make your business more attractive to lenders and investors, leading to better credit terms and lower borrowing costs. But that's not all. Businesses with strong working capital management are better positioned to respond to market opportunities and challenges. Whether it's launching a new product, entering a new market, or simply improving your customer service, having access to working capital gives you the flexibility to act quickly and decisively. And this in turn can lead to increased business value, making your company more attractive to investors and buyers. In summary, understanding and managing your working capital is key to ensuring your business remains financially healthy and poised for growth. By managing your cash, inventory, receivables, and payables effectively, you can optimize your operations, reduce risks, and enhance your overall business performance. Don't forget to check out my previous videos on liquidity and cash flow to get an even deeper understanding of how to manage your business's finances effectively. As always, if you found this video helpful, please like, subscribe, and hit the notification bell so you never miss out on any of the future tips and strategies. Well, until then, have a great day.